Okay, so we're going to go ahead and get started. Appreciate you joining us for the weekly town hall meeting with ABC. I'm Ed Capadonna, and just want to go over a couple of ground rules before I introduce the speaker to you. So once again, if you could keep your microphone on mute during the presentation so that we limit background noise, that would be great. If you have a question during the presentation, there is a chat button on your screen, either at the bottom or the top. If you want to just click on that button, type in your question, it'll come here to my office. And at the end of the program, we will run those questions by Steve to make sure that we get your answers. And then finally, we are recording this seminar. So I just want to give you a heads up on that. So we are recording each one of these town hall meetings and then providing this to the rest of the membership. So if you see a red button blinking on your computer in either corner, don't panic. I'm not trying to infiltrate your computer. It's just a recording button that's showing that we're recording it. So today's town hall meeting deals with insurance, and with us is Steve Burnett from Insurance and Financial Services. They've been a longtime member of ABC Delaware here. Steve's on several committees here at ABC, ABC Cares, Safety, and some other committees as well. They've been a longtime supporter in terms of sponsorships and other opportunities here at ABC. So we're pleased to have Steve spend a few minutes with us today and talk a little bit about insurance. So without any further ado, Steve, the floor is yours. I'm assuming everybody can see Steve's screen before we start. So if you cannot, please send me a chat. If not, you should see his screen as we go forward. So Steve, the floor is yours.
Thanks, Ed. Good morning, everybody. I hope you're all doing well. Just a couple of things. Wanted to preface the meeting with just letting you know that in the world of business insurance, it's an ever-changing challenges and new developments. So anything that I tell you today will probably change tomorrow. Just yesterday, for example, I was asked a question about directors and officers insurance related to the Paycheck Protection Program. A customer had received a sizable loan and asked me if they don't give it back and the government comes after them, is it covered by directors and officers insurance? So not something I had even given an ounce of thought to previously. So it's kind of questions we're getting every day pretty much on our side of the business. So I do handle business insurance, property and casualty insurance, and contract bonds. We do not do any health insurance. I think the ABC is going to, or may have already had a town hall relative to health insurance. So if you ask me questions about health insurance, I can't answer them. The other thing is just about everything that I'll talk about today. You'll want to, if you have further questions about your specific situation, you'll want to talk to your agent or your carrier, because there's a lot of variables and the carriers are all doing different things in response to COVID-19. So we're going to start with probably the biggest question that we get relative to business interruption coverage. I'm going to talk a little bit about workers' compensation, vacant buildings, general liability coverage, contract bonds, what Delaware has done to protect insureds, what the carriers are doing, and then some ideas for things you can do to manage your premium. So first we'll get right into the big question, business interruption. I would guess that most of you have already heard a lot about business interruption coverage or the lack of business interruption coverage. And I just wanted to go through some specifics on why business interruption is not covered by most policies. So when this all started, there were multiple lawsuits filed almost immediately. One of the most prominent ones was a restaurant owner, Thomas Keller in California, who has 1,200 employees. Super nice guy. I've seen him interviewed, and he's got really great intentions. So they filed a lawsuit trying to force the carriers to pay the business interruption claim, and he made a comment that I've been paying insurance for so many years, I don't understand why it's not covered. Well, a couple reasons it's not covered. The first is business interruption and property insurance requires that there be direct damage to the property, like a fire, tornado, hurricane. Direct damage is not specifically defined in the law, in the insurance policy, but case law has pretty much determined what qualifies as direct damage. From a business interruption perspective, typically business interruption is a time element coverage, which means it's over a period of time. So you're out of business and you get paid during that period of time. There's also a time element to the deductible. And typically on probably 90% of the policies that we write, that deductible is 72 hours. So the argument's been there is no direct damage. If you leave the virus alone for 3 days, it goes away. So that does not constitute direct damage. Additionally, the courts have determined, mostly from prior incidents, Legionnaire's disease is the one that probably started. There was many lawsuits over that, and it was determined that a virus does not constitute direct damage to a building. The first lawsuit that tried to claim that was actually before the California lawsuit, was a lawsuit filed by Oceana Restaurant, which is in downtown New Orleans, right off of Bourbon Street, and their argument was that they did experience direct damage. We'll see how that turns out. That lawsuit, of course, is brand new, so there's been no decisions made. In addition to it not being direct damage, on virtually every policy, property policy, general liability policy, just about every policy there is some form of a virus exclusion. So the primary policy issued by the Insurance Service Office does not actually exclude virus. It does exclude bacteria. So the carriers have all, for the most part, created their own virus exclusions well before this occurred, specifically stating that virus is not, virus and epidemics, pandemics are not covered on the policy. You'll also not see the words pandemic and epidemic specifically, except for the travel insurance policy that I bought for a trip. The travel insurance policies do actually specifically exclude pandemics and epidemics. The other issue, the third issue in why typical policy will not respond has to do with exclusions for government action. It's kind of interesting. The government action excludes seizure or destruction of property by the government. So a lot of the carriers have turned to that exclusion as another reason that virus is excluded. Some carriers may specifically have endorsements that identify virus as an exclusion under government action. Most do not. In my opinion, I don't think that's a valid reason to exclude coverage because it technically is not seizure or destruction of property. So when Chef Thomas Keller out in California filed a lawsuit, his big argument was, I've been paying premium for years. Like I said, I don't understand why it's not covered. Well, the simple answer to that is that insurance does not cover everything. And virus, pandemic, like war and nuclear peril, are uninsurable. Had the coverage been in place, unfortunately, your premium would have been so high that virtually no one would have been able to afford it. The carriers, in their filings, in their rate filings that they do in every state, identify specific perils that their rates are developed. They have they have rooms full of actuaries that pull the numbers together, and a pandemic is just not an insurable exposure. The carriers currently have about $822 billion in surplus, which is the money that they set aside for anticipated future claims. And that number is pretty much everybody, the government, the carriers, everybody agrees that 822 billion is a good and accurate number. And that includes the surplus funds that are held not just by the big, huge insurance companies, but also you have to remember that there are many, many very small mutual companies, regional carriers and local carriers that also write business interruption coverage and don't have funds set aside for a claim as massive as what we're experiencing right now. So if that $822 billion is an accurate number, and the estimates are, and based on the federal government programs, the estimates are somewhere around $400 billion a month in claims just for companies with 100 or fewer employees, meaning that the insurance industry, not just the specific companies, but the entire industry would become insolvent somewhere between 2 and 3 months after trying to pay these claims, and then would be unable to pay claims that are actually covered. So what's happened now is we've probably got thousands of lawsuits filed, and multiple states have presented legislation. New Jersey was the first within 2 weeks of the virus becoming evident. New Jersey introduced some legislation that would have forced insurance companies to pay the claims. Many states have followed suit. The insurance industry, of course, is fighting this because it's not a covered claim. It's just a matter of time. We're going to have to wait and see. My personal opinion is that, like Hurricane Katrina, these lawsuits will probably go on for years and years. There's still lawsuits open from Katrina, and I believe that that the courts will end up getting clogged up with a lot of these lawsuits. And again, it'll take years and years. The legislation, it's hard to say what will happen there. I know the ABC is not supporting the legislation. It's just, I believe, ill-informed, and the politicians that introduced the legislation don't have a real clear understanding of how the insurance business works. So the next topic up is workers' compensation. It's interesting. Most people immediately say, why would this be a work-related claim? The answer is it's not. It's not. Virus has never been treated as a injury or illness that occurs during the course of employment. However, with the pandemic, we have many, many healthcare workers who have been working ridiculous hours in very difficult situations. And there's, again, many states are looking at workers' comp saying, is this something that they contracted during the course of their employment? Again, there's a lot of discussion. We don't really know what's going to happen with that. I serve on the Delaware Compensation Rating Bureau and Pennsylvania Compensation Rating Bureau Rating and Classification Committee, and we had a joint meeting with the Actuarial Committee last week. So it was me and 60 actuaries. It was a barrel of laughs. And there was much discussion about what happens if workers' comp claims are determined to be, or if the virus, are determined to be workers' comp claims. The fear is that once you open that can of worms and the healthcare workers are covered for workers' comp, why wouldn't a carpenter working on a job with a group where people were infected, why would that not be workers' comp? So there's a lot of concern about that. The ABC is obviously not supporting COVID as a workers' comp claim, it would be very bad for members. We drive up the cost of workers' comp after years and years of workers' compensation improving as the result of reform. Here in Delaware, we passed reform legislation a couple of years ago. Ed actually served on the task force. I went to many of the meetings. As a result of that revisions to the workers' comp system, we've experienced massive improvements in our workers' comp loss ratio. In 2012, and the loss ratio is basically premium dollars paid in versus claims dollars paid out. In 2012, the loss ratio for paid claims, paid losses, was about 81.5% of premium paid in. So keeping in mind that the insurance companies have a lot of expenses that's not included in that, 81.5% is not a good number. So for every $100 they're bringing in, they're paying out $81.50 in claims. That number has gradually improved since 2012. In 2019, the paid loss ratio in Delaware was 41%. Incurred losses, which includes reserves as well as actual paid losses, was actually in 2019 20.3%. So we've worked very hard in Delaware to improve our workers' comp system, as virtually every state has. And had there been or should there be workers' comp claims as a result of COVID, it is undoubtedly going to deteriorate that market and force rate increases in virtually every state. So that's not something that we want to support. And again, the ABC does not support it. That said, there are multiple proposals being introduced by both the Delaware and Pennsylvania rating bureaus, as well as the NCCI, which is the National Council. It's the big national rating bureau that includes 39 states. And those proposals are meant to identify the situation that we're currently in with the virus. So the first question is, you have employees that you're paying to stay home and not work. So you have you received, for example, funding from the Paycheck Protection Program. You're paying your employees, but they can't perform their duties at all from home. So they're not working at all. So how do you classify that payroll when you have employees that are actually not working? So the proposal is to not include that payroll at all in your workers' compensation. So when the insurance company does an audit at the end of the year, they will exclude that payroll entirely. The other situation is that you're paying employees to work from home to perform different duties than how they would typically be classified. So just a simple example, me, for example, I'm included on our workers' comp policy in the outside sales class. During this time that I've been exiled to my basement man cave, I have not done any outside sales calls. All of my payroll during this time will go into the clerical class. So I spoke to a customer yesterday who has employees that work in their warehouse, in their shop, and they had to get rid of some guys. They're still paying them, but these guys are able to do some work, some functions from home, so they are working from home. So instead of being in a warehouse class, which is a very high rate, those employees and their payroll will all be included in the clerical class. Again, assuming that these proposals are approved, and I have no reason to think that they won't be approved. And then the final discussion we had in our committee meeting was, how will these claims, should workers' comp come into play on virus-related claims, how will they impact my EMR? Very important question for all contractors, because most of you know that your EMR can determine whether or not you're allowed to bid on jobs with certain owners and general contractors. So the proposal in place is to not include, again, should these become workers' comp claims, to not include any of that loss, those paid losses or reserve losses in the calculation of your EMR. They would be completely excluded, so will not impact your EMR. Also, what's come up quite a bit and from customers, and for construction, this may or may not impact you as an insured. However, if you own the building that you're in and you're not occupying it, or if you own any buildings and you're not occupying it, it does come into play. So every property policy has a limitation on it for vacant buildings. Vacant in the world of insurance means that the building is less than 30% occupied. So as long as you got 70% occupancy, and what that means is that you have everything you need in that building to conduct business. So as long as the building you still have your contents in there, you still have your computer equipment, everything is still in there, the carriers would be hard pressed to call that vacant. However, if you're out of the building, your tenants have moved out, your section of the building is only 25% occupied, the rest of it's empty, they can limit the coverage. So claims for theft, sprinkler leakage, vandalism, those are excluded once a building is vacant for 60 days. And every other claim, if a building is vacant for 60 days, every other claim is reduced by 15%. So what the carriers have done, most carriers, and again, if you're in this situation and your building could be considered vacant, the carriers have pretty much eliminated the vacancy clause from the policy. So they're not going to penalize an insured should a building become vacant. It's very important that you speak to your agent about this if you have this situation, because different carriers, the 60-day clause is specific to the standard insurance service office policy. Some carriers, it's 90 days. Some carriers don't have vacancy restrictions that are as restricting as the ISO policy. So it's very important if you have this situation to speak to your agent. And then the next question that came up is, when will my building not be considered vacant any longer? So once the governor lifts the emergency order, the clock starts ticking. So 60 days from that emergency order being lifted, you will have 60 days to occupy the building again, or the vacancy clause will come into play. We don't really expect this to be a huge problem, but at IFS, we insure many commercial properties, and we get asked this question a lot. I have 2 very large office buildings insured in downtown Wilmington that are currently almost completely empty. All of their tenants have moved out with only a few exceptions. They're well under 30% occupied, and they were concerned about whether or not those would be considered vacant should there be a covered claim. And then something that's come up more recently than for example, the business interruption, is the question about general liability. Initially, we didn't think there would be much concern with general liability. Viruses are excluded. There has to be negligence. The question is, whose fault is the virus? Well, that's changed dramatically in the last couple of weeks. There's been multiple lawsuits filed already against business owners, property owners, and also some job site owners on construction projects, trying to place fault on those parties because someone became ill from the virus, claiming that the building owner, property owner, business owner was negligent in protecting the employees or the people in the building from the virus. This one is going to be very interesting to keep an eye on. In order for general liability to respond to any claim, there has to be proof of negligence. If you have a customer, the customer that I have that has the two big office buildings, they spray the buildings down a couple times a week. They're very, very diligent. The place, all the common areas are sanitized every single night. Should someone get the virus, it's possible that they could file a lawsuit against the building owner for failing to take responsibility and clean the building up. It'll be interesting to see how those claims kind of develop over the next couple of years. Again, I think they're going to go on forever. I think there's going to be more and more lawsuits. They're going to mount up. The legal profession is looking for gaps in coverage and different ways to allege the negligence of the insured parties. So we'll just be keeping an eye on that. It's going to be ever changing. I would like to mention that the federal government not the federal government, but some of the legislators have taken this up as part of the next stimulus package. Mitch McConnell, for example, has been very adamant that he will not support any further stimulus package if it does not include protections for employers and property owners. The fear is that businesses will not open back up and buildings will not open back up for fear that they're going to get sued if someone contracts the virus after they open up. There's a lot of opposition to that on both sides of the aisle, but I believe that's going to continue to be a major point of discussion as they work towards the next stimulus package. Something else that's just come up in recent weeks is the impact on contract bonds. So if you're a contractor that does do bonded work, there's some things that you can expect. We've already seen it from our surety companies. They're coming to us and they're asking for more frequent financial updates, work on hand. They just want to see how everybody's doing financially. They want to know how contractors are handling, what impact it's going to have on their business. They're very concerned about force majeure clauses in construction contracts, which force majeure just is a clause that limits responsibility for any claims or delay in construction caused by something out of your control. So our advice there is both on your existing contracts and on any new contracts you see, have your attorney review the contract specifically relative to the force majeure clause to see if anything has changed. The sureties are concerned that the building owners and potentially general contractors are going to modify that force majeure clause and make it problematic for contractors that work for them. When you have new bids, and we've been very active, it's interesting, there seems to be a lot of work still being bid. You can expect your surety company to ask you, what are you doing about force majeure? What are you doing about market shortages, potential shortages in supplies, price escalations as a result of that? Big concern is product coming out of China because they expect price escalations and some serious shortages. And also, what are you doing in relation to subcontracted labor? So just some things to think about. I would recommend that any contracts that you are presented with or any jobs you're bidding on be very conscious of changes that have taken place and have your attorney review any of those changes, anything that's different from what you're used to. So Delaware has done some things, one thing really specifically to help protect insureds from facing cancellation and non-renewals as a result of non-payment. Currently in Delaware, it is illegal for an insurance company to cancel or non-renew all lines of insurance. This applies to both commercial lines and personal lines coverage without a court order. I don't know any insurance company that is ever going to seek a court order to cancel a policy for non-payment of premium. But in Delaware, if you receive a notice of cancellation for non-payment because you missed a payment or whatever, the carrier cannot cancel your policy for non-payment. That ruling does not apply, however, to cancellations or non-renewals for any other reason. So if you've had bad claims experience, or you're in a business that the carrier just does not want to write anymore, they can still cancel or non-renew your policy as long as it's not for non-payment of premium. So that is really the primary thing that the insurance commissioner in Delaware has done to protect policyholders in Delaware. Insurance carriers have done several things to help their customers get through this pandemic. The first is virtually every carrier is offering delayed premium payment. So if you're having trouble paying your premium or you want to put it off for a month, virtually all of them in commercial lines and personal lines are allowing, at this point it's into June, so they're allowing a waiver of premium payment for most of April they did, and May. Some of them are now extending it to July. All you have to do is contact your carrier, and the carriers don't want agents to be involved in this conversation. So it's a direct phone call to your carrier, and your agent can hook you up with the phone number if you need it, the phone number to call, and just ask them for a little relief in terms of paying your premium. They will not charge fees. They will not charge penalties. It does not relieve you from having to pay the premium. It just postpones you having to pay the premium. In addition, if you're in a situation where you've got, for example, a renewal coming up that you've typically paid full annual or quarterly, the insurance carriers, most of them are now offering 12-month payment plans so that it spreads the premium payment out a little bit, just to help insureds, again, get through without getting slammed with big insurance bills. The one thing they've done that's kind of a big deal for some businesses, I'm not sure about construction, but they have extended personal insurance and commercial auto insurance to allow for delivery. So commercial auto policy, if you take, for example, a pizza shop, pizza shops, thanks to Domino's Pizza years ago, typically do not have coverage for hired or non-owned vehicles. In other words, delivery people delivering their pizza in their own personal vehicle. The personal auto policy also has limitations relative to delivery for business. So most carriers, not all, but most carriers have suspended those limitations on, again, both personal and commercial auto coverage, so that if you have, and it doesn't just apply to pizza, but if you have employees that you're paying and they're using their personal truck to make deliveries for you, that previously could have been problematic for both you and the employee who owns the truck. With most carriers, again, you have to check with your agent, but most carriers have suspended that limitation and will keep that in place until we get through this. Also on monthly installments, initially, insurance carriers were only giving credits on monthly installments on personal auto policies as a result of the lessened use of vehicles and less driving. So those credits were applied to April, May. Again, most of them have extended that now, some into June, some into July. The most common credit that we see is 15% off of your monthly installment or your monthly premium. Now we're seeing some carriers are doing more, 25%. We have a carrier that's doing 35% credit off of personal auto. In the last couple of weeks, several carriers that are involved in Delaware that are fairly significant writers in Delaware have extended that credit to apply to commercial auto. That credit may come in the form of credits on monthly installments. It may come in the form of a check. Some carriers are going to apply the credit on your renewal next year. I have a customer that's with one of the big carriers in Delaware. That carrier is going to do 35% credit April, May, and June. Their insurance renews in October, so they will see that credit applied to their October renewal. So keep an eye out for that. If you don't see a difference in your installments or a reduction in your premium, or you don't get a check from your insurance company, I would suggest calling your agent and ask them if your carrier specifically is offering those credits. Again, on personal lines, it's almost universal. Virtually everybody is offering the credits. Commercial lines, it's not everybody, but it is an increasing number of carriers that are offering the credits. Also, just wanted to mention that everybody's mad at the insurance companies because they won't pay business interruption claims. The industry as a whole has donated billions and billions of dollars to help to communities, to help fund relief. One carrier, one single carrier donated $2 billion a couple of weeks ago. So in defense of our industry, I guess I just would like everyone to know that the carriers are doing a lot and taking this very seriously. So before this all started, just to give you an idea where the industry is right now and what you can expect going forward from the carriers. Before the virus started, towards the middle to end of 2019, we started to see signs of the marketing tightening up. We've been in a very extended, what we call a soft market, for probably 10 years or so. And a soft market typically is very competitive. Insurance carriers are willing to write a broad range of businesses, including some high hazard businesses. There's a lot of competition, and it's great for anybody buying insurance. We're a cyclical business, so we've been through the soft market about 5-6 times in the last 100 years, and eventually the soft markets end and the market tightens up for a variety of reasons. And we started to see signs of tightening. The first place we saw signs was in commercial auto market. Any of you that have renewed your commercial auto in the last 3 or 4 years know that your premium has gone up, likely has gone up. For the cleanest of accounts with few or no claims, right now we're expecting 8 to 10% premium increases on commercial auto. That is principally a result of two things: increased cost of repairs. The side view mirrors used to buy for $350 when they got clipped off. Now have computers and all kinds of fancy sensors in them, and now cost $2,000 to $3,000. So the cost of repairs has gone up significantly. The major problem is, however, distracted driving. So that's the biggest challenge in our industry. It's a challenge for everyone who drives. It's a challenge when you drive, because so many people insist on being on their phone, texting and talking. Distracted driving causes two things to happen. In our industry, we talk about frequency and severity, and distracted driving accidents include both of those. There's much, much higher frequency and much, much higher severity. Typically in a distracted driving accident, the at-fault driver who was yakking on their phone or sending a text fails to see the cars, and fails to hit the brakes. So the claims are much worse, and we're just seeing more and more of those claims. So we've seen that going on. We expect that to continue until the carriers can get to a position where the commercial auto is actually profitable. Right now, it is not profitable for them, and many carriers are contracting on what they'll write in commercial auto. It's becoming a problem. On commercial property, we started to see that the catastrophic losses over the last 5 years, predominantly hurricanes and tornadoes and wildfires, are starting to catch up with the industry as a whole. So we've seen some modest increases in property. We expect that to worsen over the next year or two. Property is still a profitable line, so I wouldn't expect huge increases, but I would say that you're going to see some increases in property. Big areas where we're seeing problems is in general liability, and mostly in umbrella capacity, meaning that the insurance carriers, if they wrote a $25 million umbrella before, we're seeing commonly with all of our customers that have limits as high as that high, the carriers are pulling back and saying, we only want to offer up a $5 million umbrella. I just renewed an account that's a property manager who had a $25 million umbrella with a real estate program out of New York City. The premium last year was $11,000 for a $25 million umbrella. They pulled that program. They won't write property managers anymore. In their renewal, which is this Friday, we were able to place a $5 million umbrella for $4,000, and the additional $20 million umbrella was $25,000. So their premium tripled in one renewal because of the lack of capacity amongst umbrella carriers. So if you have an umbrella and you have a high limit, you can expect to potentially see some challenges in retaining that high limit. They're just not interested in, the carriers don't want that much exposure on one policy anymore. Oddly enough, workers' compensation, we talked about this a little bit earlier, workers' compensation remains a bright spot. If you had told me 10 years ago that I would ever say that, I would have said you're nuts, but it is, as evidenced by the improved loss ratio in Delaware, it is a bright spot for employers. As long as the COVID claims don't become part of workers' comp, don't become workers' comp claims, we expect that to continue. The reform that's been passed in Delaware and other states has been very successful. We've gone to fee schedules for medical claims that has dramatically reduced the amount paid out in Delaware. So we think workers' comp will continue to be a competitive market, again, as long as we don't, the COVID claims don't come into play in the workers' comp arena. So in the last several years, I would suspect that most of you have bought cyber liability coverage, hopefully. If you haven't, you probably should. You've probably purchased employment practices liability coverage, which covers harassment and discrimination claims. And you may have purchased management liability coverage, which is directors and officers coverage predominantly. We've seen on every renewal in the last 6 months increases in premium in those lines. I just got a renewal in yesterday for a employment practices liability policy. The premium went up about 12%, which isn't terrible, but there's a primary factor coming into play with the employment practices liability is the Me Too movement. Once that started, there's been a dramatic increase in claims. We expect that to continue. It just seems like it's endless. This product was introduced about 15 years ago. The carriers had no idea how to price it, didn't know what the exposure was. It was very, very expensive. Over 10 years or so, the premium came down. The loss experience was outstanding. Didn't have a lot of activity, mostly a lot of nuisance claims by disgruntled employees. That's changed dramatically. and we expect that the employment practices liability market is going to start to tighten up a little bit, and you're going to see some increases in premium. Cyber liability, like employment practices, when it was introduced only a couple of years ago, it was a guessing game as far as pricing. The carriers had no idea what the exposure was, didn't know what to expect. The products have grown and expanded dramatically, have responded to new threats. Premium has been relatively affordable depending on what kind of business you're in. Now we're seeing a lot more claims activity, most of it coming from cyber extortion type claims. So starting to see modest, again, just modest increases in cyber liability. But we would expect that if these claims continue to increase, we would expect cyber to become more costly over the next year or two. And on the directors and officers liability, that's tied directly in with employment practices many times. So when there's an employment practices claim, typically the directors and officers of the company are also sued. So as employment practices claims go up, we anticipate that we're going to see an increase in directors and officers claims as well. So then the question becomes, what can you do in this crisis to manage your premium and control your costs? From a contractor's perspective specifically, much of your cost for insurance relies on rating exposures, payroll, subcontracted costs, potentially gross receipts. We've had many customers contact us and ask us to reduce payroll, reduce their subcontracted costs, reduce the estimates on the current term. I would suggest that you do take a look at that. It's a good way to reduce your premium going forward. With some caution, don't reduce it too much. The carriers are still going to do audits, and if things pick back up, if you hire more employees and your exposures go back up, they'll just pick that up on the audit. But it is a relatively quick and easy way to reduce your premium currently and then revisit it when things start to pick up again. The insurance carriers in the past have been very reluctant to make those changes midterm. They aren't anymore. They're willing to work with the customers. They're willing to work with policyholders to help you control your cost, and they will endorse policies in the midterm to reduce any rating exposures. Unfortunately, you can't really drop vehicles off your auto. I get asked that question a lot by my customers. Can I take these 10 trucks off? I'm not using them anymore. You can, but you have to turn the tags in, and they can't be registered anymore, and you can't drive them, and it's kind of a problem. As long as those vehicles are still tagged, you have to keep those vehicles insured. My other advice would be to keep very accurate records for your upcoming audits, especially as it relates to workers' compensation. If you have employees who have changed their duties and would fall into another classification, the onus is going to be on you as the policyholder to be able to provide those records to the employer. So if you have an employee that you're paying to work from home, and that employee is performing clerical duties as opposed to whatever else they would have normally been performing, you're going to have to prove that to the auditor. So it's important that you keep accurate records going forward so that you can take advantage of the potential lower rates. Also, if you're in a business where you carry a lot of inventory, many of our customers who are in the supply business have reduced inventory. You can drop those numbers down. Typically, property insurance is not a big, huge chunk of your premium, but might as well take advantage if you can and lower those inventory limits to a more reasonable level. If I have a customer that's a big supplier, their inventory is way, way, way down. So potentially, we talked about it the other day, we could be reducing their inventory limits by several $1 million, which is going to add up to some serious premium. Also going forward, somewhat related to COVID, but mostly related to what we expect the market to do in the next couple of years as the market hardens. I think it's very important that you step up your loss control and claims management. Safety programs, I've been spouting about this for years, but it's even going to become more important whenever the market hardens. The carriers become less willing to write certain types of businesses. If you can prove to them that you've got an effective loss control program and a claims management program, it helps tremendously with the availability of coverage. So that is about everything I was going to go through. And now, Ed, I guess we'll open up to if there's any questions.
Well, thanks, Steve. I appreciate it. Very nice presentation. If anybody has any questions, you can unmute your phone or unmute your microphone and ask the questions. I don't see anything in the chat room, so I think we're good there. So if you have a question, go ahead and unmute your phone or your microphone and go ahead and fire away. Don't all ask at once. Okay. Looks like there's one here. You will get a copy of the presentation. We are recording this presentation. It will be emailed out to you sometime tomorrow or Friday from Gene. So you will get a copy of the presentation that Steve made today. Anybody have any other questions you'd like to ask? Okay, Steve, we appreciate you taking the time out.
Thank you all.
Thanks, Steve.
Stay safe.
Well done.
Take care and be safe.
Thank you.
All right. Bye-bye.